Welcome to Overpolarized TV. Today I'm in London together with Dave Fishwick from M&G Investments. Dave runs a global macro fund for M&G. Dave, tell us a bit about M&G, the history of the company. I know it's been around for a while, and also please introduce yourself.
M&G is the money management arm of Prudential, the UK Prudential, large asset manager, predominantly running long-only strategies, but I've been running macro strategies for M&G and in earlier guises part of Prudential for around 20 years or so. I started back in the 1980s as an economist straight out of university and was asked to forecast European economies, and was employed using strategies, macro strategies, on large multi-asset funds. That is, the derivation of the strategy was a tactical asset allocation strategy, and my task was to try and forecast economics. And then I've moved on to currencies, bond markets. I then spent some time down in Australia. My wife is Australian, so there I was again engaged in macro strategy. And when we sold that business, I came back to the UK in 1999, where I was asked to head up a team and a resource and to run the strategy that we've been running ever since.
Dave, tell us in more detail what's special about the way how you run your strategy.
The strategy itself is different in a sense to the macro strategy. It's a discretionary strategy, and the source of that difference is really going back to, as I mentioned, my early days as an economist. So what we discovered or found out during that phase was that systematically out forecasting people on the cyclical maneuverings of the world economy is a pretty tricky thing to do. So I would say today most discretionary macro strategies have at their core a view-driven perspective. So they're trying to have an informational edge and understand better than the pack where economic dynamics are moving. Now, my observation on that at a relatively early part of my career was that we had some glorious successes at being better at forecasting people, but we also had some glorious failures. And over time, it was pretty clear it was very hard, particularly in high-frequency economic forecasting, to be better than everybody else. Now, secondly, more irritating than that, even when we had some glorious successes at forecasting economics better than other people, was that financial markets didn't necessarily do what you might expect them to do. So the premise of a lot of these view-based strategies is that if you can forecast economic dynamics, you'll know what markets would do. Now, my observation would be that actually a lot of what goes on in the market is not about that journey, the evolution of economic beliefs, motivated and driven by news flow, but is actually about the emotional experience of owning assets. So I would observe, along with people like Robert Shiller, who's a kind of grandfather of behavioral finance, that a lot of the volatility you see in markets is not explainable purely by the fundamentals themselves. So what we noticed relatively early on was that when we got economics right, often markets didn't do what we'd expect, and some of the bigger movements you see in markets don't necessarily seem to have fundamentals at their core. So this attracted me, I have to say, to more quantitatively driven strategies, which effectively said, if you're going to take the market on here, what you're trying to get at as the market's most likely mistake or inefficiency is more around how a market processes its information to turn that into price, and the fact that this is a highly variable relationship. So some of the quantitative elements appealed to me, but I would then, trying to use that approach, again encountered more difficulty around the fact that some of the structural relationships in economics to do with inflation and profitability, and then how risk is priced over time, have long phases of correction or different regimes which render a kind of static view of all of that rather tricky or even redundant. So I spent a lot of time then reading psychology literature and arrived at a place where I thought I could understand the emotional journey that markets go on, and try to generate returns out of almost a superior emotional intelligence rather than forecasting prowess and knowledge about economic fundamentals. So we still have some views on inflation, we still have some views on profits, and we still have views on where real interest rates should be, but they are of a regime nature, which makes us different in the context if you ask me for my view about anything at any point in time. Although I'm tempted humanly to give you a view on the economics, and I have high frequency economic views, we would prefer to couch a lot of it in how a market is already priced, what the odds are in financial markets in a sense, and to effectively try and generate returns out of markets being surprised by how they feel rather than what they know. So again, if I go on macro panels, which I have lots of times, many of my co-panelists will talk about their view of the Chinese economy or the Federal Reserve meeting that might be coming up. A lot of my responses will be talking about how things are already priced and about the emotional dynamic that I think drives markets more frequently. So in that sense, although I've seen other people with similar-ish type strategies, certainly in the arena of global macro strategies, I would never claim we're unique, but we are very different in the sense that we don't have these very strong macroeconomic views about high-frequency dynamics.
I think that's fascinating, but please tell us in more detail, how do you form an investment out of your approach that includes behavioral finance and psychology?
So just to put a bit more detail on that for you, I think the answer really relates to trying to isolate situations where we think rapid price action, which causes confusion and emotional upset, has driven some valuations to stretched points where we think that they can snap back from. So the specific sorts of things we're looking at, we've seen examples such as the taper tantrum, which drove emerging market currencies rapidly down and drove bond yields rapidly up, and created a situation where the experience of owning those things was a negative one. And that sense of I've just been hurt overwhelms investors rather than the fact that actually the payoffs have just improved. So in that example, the back end of 2013, we were purchasing long-dated government debt, which had had a very unpleasant journey around the taper concerns in the United States, and baskets of emerging market currencies. Now, interestingly, in this frame of time, one of the essences of the strategy is that I didn't want to buy them either. So at the very core of what we're trying to do is I end up initiating lots of trades that I find deeply upsetting to actually engage into. So there's almost a core part of what we're doing here is a mindset of learning to do things that don't feel comfortable. And again, I can contrast that with a view-based strategy, where in order to come up with those trades, I would have had to be saying, all of that's going to get reversed, US interest rates are definitively not going to rise. Those types of observations. Instead of that, I was listening to the drumbeat of the emotional journey of the market and hearing that people were under stress. Now, similarly, if I kind of transfer that into calendar early 2015, bond markets have had a lovely phase, and people's sense of what it's been like to own them was vastly different. And so you saw a very powerful early 2015 rally in government bonds, which we were then stepping against. Now, again, when I did that, I couldn't identify specific economic arguments about why interest rate structures were going to reverse. But I was clear that other people had become extremely comfortable with the ownership of these assets, having previously disliked them with levels of yield way above where you now were. So it's almost a kind of irrational sense of how to think about the future. So the essence of all of these things is we're trying to see where recent experience and price action has blown people off course, and they've almost forgotten what they used to believe. Now, for us to do that, because we're prone to the same urges and emotions, we have to use a set of valuation tools that measure this emotional response. So relatively simple valuation tools, nothing particularly proprietary about them, where we're measuring these risk premia shifts or this sense of how I want to be compensated for uncertainty and looking for stretched elements of that pricing. So at the core of what we're doing is a fundamental value observation, but with this very powerful overlay of I want to try and identify these episodes of price action which we think has caused confusion. So there are lots of examples. It's not always about catching falling knives. It's about identifying situations where the experience has tainted people's sense of how they should be paid for things. And although they kind of know that they should like something more or like something less, they don't. And those are to do with deep human biases that are very, very difficult to remove. I believe that we, over the course of 15 years, have learned to try and cope with those, but it doesn't mean I don't have the same emotional tendencies, but we have learned to try and overcome those and, as I said, do things that we almost don't want to do. So this is not an easy strategy to implement. I think that's a very important point, that it is a hard thing to do. It sounds initially attractive, but the reality, of course, is that other human beings are not stupid. I'm not identifying other people's stupidity. You're identifying the fact that human beings aren't very good at coping with some of these types of things. That means I'm not very good at coping with them either, but we've learned to try and do something about that. And I think for me, that makes a plausible sense of why this can be durable, why it's hard to copy, the fact that I've put hundreds, if not thousands, of these trades on over the years, and I still find each new one still very emotionally difficult to do. So it's not a comfortable strategy. It doesn't make me confident when I'm talking about it. So when I talk about portfolio positions, a lot of them people sit there and go, really? That's an interesting, because again, it's counter to most people's common perceptions.
So I understand that over the 15 years you have developed your toolbox, you have developed your procedures, and tell me more about the team that you have assembled and that you're working on within your structure.
So the team is a very important part of this approach because, as I said, it's not emotionally easy to do and it's not a particularly conventional approach. So the team, in a sense, have to buy into that and want to do it, not in a fitting in sense, but genuinely believe it, because a lot of the trades that we're doing are tricky to engage with emotionally and to stay with if they go against you. So it's not particularly surprising then that the team of people that I have working with me, which is a team of kind of 6-7 people, have an extremely long history of working together. So several of the people I've worked with for more than 15 years. One of the members of the team, Juan Nevada, I've worked with since 1988. So again, we've developed a lot of this thinking together over the years. So all of these guys are trained economists who've kind of rebelled against their economics background in a sense, and have learned instead to try and think carefully about what asset prices are and the complexity of that. And then we split the world up into various regions and some asset classes, not because anybody knows more than anybody else necessarily, purely on a division of labor basis. But a lot of the ideas about various trades come in a collective way, so there's a holistic view of the world. Nobody owns trades, we don't split the book up, we have a single book where I'm, in a sense, the kind of ultimate trigger puller on the portfolio, but I'm getting lots of ideas, and the portfolio construction piece is very important to us as well. So there's a very long-standing team. Again, you can kind of analyze how many people is the right number in a team to run numbers of these types of strategy. Again, for me, it's not 2 people and it's not 20. But we've had people that have joined us over the years. Eric Lonergan is the kind of a baby of the team. He's only been with us since 2006, but I worked with him previously very closely in his previous employment as well, since the late 1990s. So there's a very long-standing, very low turnover team that have bought into the approach and are able to implement that approach and that methodology. Now then, we also sit inside the broader M&G, which, as I said at the start, is the kind of one of the largest European money managers, the largest UK insurance company, We've run internal money for that as well as macro strategies elsewhere. And so the infrastructure that M&G provides in terms of risk, so there's an external observation on risk for us as well as our own risk analysis, there's dealing, there's compliance, all that sort of infrastructure. And again, people over the years have wondered whether or not you could run these types of strategy in such a large institution without interference. Could you be sufficiently entrepreneurial? And I think actually we are testament to the fact, having now been running the Cayman Fund for a decade, as of this coming August, that this can be achieved. And that's testament again to the organization's center of entrepreneurial behavior and our own understanding of the nature of the environment. So it's been a happy coexistence of a long-standing team inside a large institution that has enabled us to still be sufficiently entrepreneurial and flexible and without any interference in terms of the strategy. So I had the freedom to create the strategy, implement the strategy, both on Prudential's own money and the money we've run in the other funds as well. And so it's been a thoroughly enjoyable and comfortable existence in terms of that. Financial markets are permanently testing, but in terms of the institution, the way the teams worked, it's been a very, very pleasant, stable situation.
So Dave, you've been running the strategy since 2001. That's a long time, and you've been doing that successfully, annualizing about 10% annually. What has been the experience for you running the fund and the strategy with your approach through all those years?
So the environment has been changeable, so we get these kind of regimes. So the strategy works very well in situations where the thesis of excess volatility versus relative fundamental stability most manifests itself. So some environments are more fertile than others. We did extremely well in the phases around the TMT bubble and bust of the late 90s into the early 2000s. Driven and signaled by valuation metrics for us. It wasn't an emotionally easy thing to take on, but there were some very clear signals from the indicators that we use. Then you have other phases where things are a bit calmer and some returns can be a bit more difficult to eke out, but there are kind of multi-year episodes and trends that correct through there. So the mid-2000s was very much that sort of situation. There are times when you get massive economic trauma that can confuse the signals. And so in those environments, it's very hard to differentiate between the emotional piece of price volatility versus fundamentally motivated price volatility. The best example of that is 2008, where we struggled with what was economic chaos and trauma against valuation metrics telling you that you were being overcompensated and the trauma had indeed caused a lot of observable stress. So that was an environment in which the returns on the fund were volatile, were problematic for us in a sense because prices went against the valuation indicators for a period of time. Now, our own analysis of the kind of risk management challenge here, particularly with this strategy, is that our natural instinct is to not want to engage in a lot of conventional risk management centered around the notions of stop loss and drawdown containment, because the essence of the strategy is to take on the stress and engage with the stress rather than avoid it. But of course we can't afford to either frighten ourselves too much nor frighten our investors. So we don't have kind of a scientific set of targets for volatility or drawdown, but we kind of know through the experience of running the fund over 15 years what are acceptable and reasonable things to do. So in the essence, we're trying to avoid double-digit moves in short spaces of time, whether it be a calendar month or 6 weeks. That's not in the spirit of what we're trying to do. If you look at the long-run track record of the history of the strategy, 3s and 5s plus or minus tend to be quite meaningful events for us. So in a sense, the risk management is about engaging in a targeted way with what we see as euphoric environments or stressed environments where volatility does tend to pick up. So we have to try and contain the volatility while not surrendering the original thesis. Again, that kind of stop loss culture doesn't work for us very well. But of course, we have a very clear eye on the historic map of volatility, of correlations, and we can road test portfolios through previous stressful events, through other environments to see the kind of nature and the magnitude of risk that we're taking. Right at the beginning of the, we talked about the belief set that lies behind the strategy, where in a sense, my view about life is that we're being, in a sense, reasonably arrogant in saying that we know stuff. And again, some of the kind of emotional superiority language can sound arrogant. What I would like to say about what it is that we're trying to do is that we are humbly arrogant, by which I mean we're observing that we're trying to understand how little we know, and in a sense trying to generate returns out of other people, almost not realizing that they don't know very much about the economics. So looking at those kind of surprises. But in doing that, we are engaging in a situation where there is volatility around overconfidence and then big shocks to people's beliefs. So the risk management element is important to us, even if we have a relatively unconventional way of looking at that. Now, what I would say today is the last 2 years, 2.5 years, have been a highly fertile environment for us, and we've delivered some strong returns by observing, in effect, that people were hugely volatility averse. So I would say one of the curses for the industry, in a broad sense, is its treatment of volatility as risk. Whereas I worry really about where my next set of returns coming from. How can I make people money? Obviously, volatility and risk are of a concern to people, and we try to do what we can in that environment. But I think the biggest risk in the last 2 years has been avoiding risk. So by not taking on some volatility, you've kind of hidden in short-dated debt instruments or cash, and you've been suffering negative real returns as a consequence. Now, a lot of this now has kind of played out as bond yields have fallen, and equity yields have now fallen, and the returns to our strategy have been strong. The environment going forward here, I think, is going to be a fertile one for us. We're getting some strong valuation signals about the way that risk assets are still priced. But there's a kind of deep, unstable disequilibrium in the marketplace, which is these real cash rates and now negative nominal interest rates in several places have impacted the pricing of lots of others. And there can be a confusion, I think, about quantitative easing having caused these things. But the real issue is that cash rate drives your sense of how much you want to be compensated for taking on other chains of risk. You're now arriving in a situation where many of those assets are priced as if these very low real rates are kind of near permanent. And yet, we're actually kind of already confronting a situation where some of these things might well be about to start normalizing to some extent. This has the capability of pressuring a whole load of other assets. And again, that's not me economic forecasting. I'm merely rehearsing what might happen in scenarios in which those real interest rates move. So although it's a tricky situation, our valuation approach and our thesis here is well set up to try and deal with this, observing on why other people are willing to accept such low returns on these assets. They've had a wonderful emotional journey. And I think we're nicely positioned in terms of the way portfolios currently look, but I also think in terms of the thesis about the nature of the environment, because my own sense is that there is going to be acute volatility in some of these assets, whether or not rates rise, or instead whether they stay low. There's in a sense a kind of binary element to that. But I think in a sense it's too strong a phrase to say that there's a storm coming, but there are challenges definitely coming. And I think we're quite well positioned, I think philosophically, to be able to try and take advantage of some of those ideas.